There is a specific kind of frustration that belongs uniquely to stock market investors who feel like they are working hard but not making real progress. They read the financial news carefully, they follow the analyst recommendations, they buy shares in companies everyone seems to be excited about, they watch the prices move up and down and try to respond intelligently to what they see. And yet, at the end of the year or the end of 5 years, they discover that their results are mediocre at best, that they would have done better simply buying an indexed fund and doing nothing. This frustration is not accidental. It is the predictable result of a specific misconception about what stock investing actually requires. The misconception is that successful investing is primarily about finding the right information, the right news, the right analyst report, the right tip, and acting on it before everyone else does. The reality, documented by decades of research and demonstrated by the consistent track records of the most successful investors in history, is entirely different. Successful stock investing is primarily about understanding businesses, understanding what makes a business genuinely valuable, understanding what protects that value from competition, understanding how to evaluate whether the price you are paying for a piece of that business is reasonable relative to what the business is actually worth. Pat Dorsey spent years at Morningstar, one of the most respected independent investment research organizations in the world, studying what separated the companies that created lasting shareholder wealth from those that did not. His conclusions, drawn from the analysis of thousands of companies across dozens of industries over multiple market cycles, converge on a framework that is both intellectually rigorous and practically applicable. In this video, I want to give you a thorough, honest, deeply researched exploration of that framework, not a superficial summary, a genuine engagement with the ideas that have shaped how serious long-term investors think about stock selection. We are going to cover what a business moat is and why it is the single most important concept in stock analysis. We are going to look at the specific sources of competitive advantage that create durable moats. We are going to explore how to evaluate management quality and why it matters far less than most investors assume. We are going to discuss valuation, how to think about what a business is worth and what price represents genuine value versus expensive hope. And we are going to look at the specific mistakes that destroy most investors' returns and how to avoid them. These ideas are not new. Many of them trace their lineage directly to Benjamin Graham, whose work we explored in the previous video, and to Warren Buffett's evolution of Graham's approach. But Dorsey's contribution is to present them with unusual clarity, with specific practical tools, and with extensive real-world examples that make abstract concepts concrete. Let us begin. Chapter 1: Why most stock pickers fail and what the research actually shows. Before we explore the framework for successful stock investing, I want to spend time on something that most investment books skip over entirely: the honest, data-driven picture of how difficult successful stock picking actually is, and why understanding this difficulty is the essential starting point for doing it well. The research on active investment management is extensive, consistent, and largely ignored by the people it most directly concerns. Study after study, across different time periods, different market environments, and different countries, arrives at the same basic conclusion. The majority of actively managed investment funds, funds run by professional investors with full-time research teams, sophisticated data systems, and years of experience, underperform the simple index fund that passively tracks the overall market. The standard figure cited is that approximately 70 to 80% of actively managed large-cap equity funds underperform their benchmark index over a 10-year period, and the percentage rises as the time horizon extends. Over 20 years, the underperformance rate exceeds 85%. And these are professional investors, people whose entire careers are dedicated to finding stocks that will beat the market. For individual investors, who typically have less time, less information, fewer resources, and less analytical training than professional fund managers, the challenge is proportionately greater. The odds of consistently selecting stocks that outperform the market over extended periods are genuinely low. I am not beginning with this to discourage you from engaging with individual stocks. I am beginning with it because honest engagement with this reality is the prerequisite for avoiding the specific mistakes that cause most individual investors to underperform. Because the mistakes are not random, they are predictable. They arise from specific misconceptions about what drives stock returns. And understanding what actually drives long-term stock returns is the foundation of everything that follows. What drives long-term stock returns, research shows, is not market timing, not reacting to earnings surprises, not following analyst recommendations, not identifying the next hot sector. What drives long-term stock returns, primarily and overwhelmingly, is the quality and durability of the underlying businesses owned. Companies with durable competitive advantages, businesses that are genuinely difficult to displace from their market positions, generate superior returns on capital over extended periods. These superior returns on capital compound into superior growth in intrinsic value, and superior growth in intrinsic value purchased at a reasonable price produces superior long-term investment returns. This is the insight that organizes the entire analytical framework we are about to explore. The central question is not, what will this stock price do next month? The central question is, what is the quality and durability of the competitive position of this business? And the analytical tools we will discuss are all ultimately tools for answering that question with greater precision and greater confidence.
Chapter 2. The Economic Moat, the single most important concept in stock analysis. The concept of the economic moat is borrowed directly from Warren Buffett, who coined the term decades ago and has used it as the organizing principle of his investment approach ever since. It is the central analytical concept in Dorsey's framework, and understanding it deeply, not just recognizing the term, but genuinely understanding what creates a moat and what does not, is the foundation of everything else. A moat, in a medieval sense, was the body of water surrounding a castle that made it difficult for attackers to reach the walls. An economic moat is the structural competitive advantage surrounding a business that makes it difficult for competitors to erode its market position, its pricing power, and its profitability. Here is why the moat concept matters so much for investment analysis. In a free market economy, profitability attracts competition. When a business earns unusually high returns on its capital, when it generates more profit per dollar of assets than the typical business in its industry, competitors notice. They enter the market, compete for customers, apply price pressure, invest in competing products and services. Over time, in the absence of any structural protection, competition erodes profitability back towards average levels. This is the fundamental competitive dynamic of capitalism. It is powerful, relentless, and historically reliable. Most businesses that earn above-average returns today will not earn above-average returns in 10 years because competition will have eroded those returns toward the mean. Except for the ones with genuine moats. A moat with a genuine economic moat has some structural characteristic, some feature of its competitive position that makes it genuinely difficult for competitors to replicate its advantages. Competitors can see the high returns being earned, they can attempt to compete, but the moat prevents them from succeeding in eroding those returns to any meaningful degree. The analytical importance of this for investors is profound. A business without a moat, earning high returns today, is likely to see those returns erode over time as competition intensifies. The intrinsic value of such a business may be high today, but will likely be lower in the future. A business with a genuine, durable moat, earning high returns today, is likely to continue earning those returns or growing them for years or decades into the future. The intrinsic value of such a business is not just high today, it is growing. This is the distinction that separates mediocre stock analysis from excellent stock analysis. The mediocre analyst looks at current profitability and extrapolates it forward without asking why the profitability exists and whether it can be sustained. The excellent analyst asks what structural characteristic produces this profitability, how durable that structural characteristic is, and whether the current market price adequately reflects the long-term value creation that durable competitive advantage enables. Dorsey identifies 4 primary sources of genuine economic moats, 4 structural characteristics that can, when genuinely present, protect a business's competitive position over extended periods. We will examine each in depth with real-world examples that make the concept concrete rather than abstract. Chapter 3: The 4 sources of economic moats, where durable competitive advantage actually comes from. The first source of competitive advantage is intangible assets, brands, patents, licenses, and regulatory approvals that competitors cannot simply replicate or purchase. A powerful consumer brand creates competitive advantage through a specific mechanism. It allows the company that owns it to charge prices above those of competitors offering functionally equivalent products, because consumers have developed a preference for the brand that is not purely rational, that persists even when comparable alternatives are available at lower prices. The Coca-Cola Company is the most frequently cited example of brand as moat. The Coca-Cola formula has been available to any competitor willing to invest in reverse engineering it for over a century. Hundreds of cola products have been introduced as alternatives. None has succeeded in displacing Coca-Cola from its market position in any sustained way. The brand, built over more than 100 years through consistent advertising, distribution ubiquity, and cultural association, creates a consumer preference that has proven nearly impervious to competition. Warren Buffett has described his investment in Coca-Cola as one of the clearest examples of moat investing he has ever made. He purchased his initial position in 1988 when the company's brand was mature and its competitive position appeared as fully valued. He has held through decades of fluctuating market prices because his conviction was not about short-term price movements, but about the durability of the brand's competitive advantage. His Berkshire Hathaway investment in Coca-Cola has generated returns that have compounded for decades. Patents represent a different form of intangible asset moat, one that is explicitly time-limited but can be enormously valuable within its duration. Pharmaceutical companies with patents on effective drugs enjoy a period of protected profitability during which they can charge premium prices without competitive erosion. The patent expires, generic competition arrives, prices fall dramatically. The patent moat is real but finite. The analytical challenge with brand moats is distinguishing between a brand that genuinely creates pricing power, that allows the company to charge more than competitors for equivalent products, and a brand that is well known but commands no pricing premium. Not every famous brand is a moat. A brand that people recognize and buy because of low prices or convenience is not a moat. A brand that people pay more for because of genuine preference, that survives consumer testing, that maintains market share against cheaper alternatives is a moat. The second source of competitive advantage is switching costs, the friction that makes it painful, expensive, or disruptive for customers to move to a competitor. Switching costs are particularly powerful in business-to-business software and enterprise technology.
When a company deploys an enterprise resource planning, a large, complex software platform that manages finance, operations, human resources, and supply chain across the entire organization, the switching cost is enormous. The data migration alone would take months. The retraining of hundreds or thousands of employees would be expensive and disruptive. The risk of business disruption during transition is significant. SAP and Oracle, the dominant enterprise software companies, have maintained their market positions for decades, partly because of the switching costs embedded in their platforms. Competitors can offer better features, better pricing, better customer service, but the cost of switching in time, money, risk, and disruption keeps customers locked in. For investors, businesses with high switching costs have a specific and valuable characteristic. Their revenue is sticky. Customer retention rates are high. The business doesn't need to constantly win customers away from competitors. It simply needs to not lose the customers it has. And since it's genuinely difficult for customers to leave, the business can maintain pricing and profitability with relatively modest ongoing sales effort. Switching costs exist in consumer markets too, though they are often less dramatic than in enterprise software. A person who has used the same bank for 15 years has a meaningful switching cost, not in money necessarily, but in the time and effort of changing direct deposit, automatic payments, and all the connected services. This is why bank customers are notoriously loyal even when competing banks offer better rates. The third source of competitive advantage is the network effect, the phenomenon by which a product or service becomes more valuable as more people use it. The network effect is one of the most powerful moat sources available, and it's also one of the most misunderstood. Not every business that benefits from having a large user base has a genuine network effect moat. The test is specific. Does an additional user make the product or service more valuable for all existing users? If yes, the network effect is present. If no, what exists is simply scale, which is different. In television network, the telephone network is the classic economic example of a network effect. A telephone with only one user is useless. With 2 users, it has minimal value. With 1 million users, it is enormously valuable because each user gains access to everyone else in the network. The value of each membership grows with the total size of the network, and this dynamic creates a powerful competitive barrier. A competing telephone network with fewer users is less valuable to any individual user, making it difficult to attract users away from the established network. In the modern technology landscape, network effects are among the most powerful competitive moats observable. Facebook, or Meta, built a social networking moat that proved essentially impregnable despite significant competition from Google+, MySpace, and dozens of other social platforms. The reason was not superior technology, it was the network effect. Your friends were on Facebook. That made Facebook valuable to you regardless of its relative technical merits. And the friends who were there because you were there made it valuable to someone else. Visa and MasterCard are perhaps the clearest examples of network effect moats in financial services.
Their value to merchants comes from the fact that consumers carry their cards. Their value to consumers comes from the fact that merchants accept their cards. Each additional merchant acceptance makes the card more valuable to consumers. Each additional cardholder makes the network more valuable to merchants. The virtuous cycle reinforces itself continuously. The analytical importance of distinguishing genuine network effect moats from mere scale is significant. Many technology businesses that appear to have network effects, on close examination, have only scale advantages. They are larger than competitors, but their product does not become more valuable to individual users as they grow. Genuine network effect moats are rare and extraordinarily valuable when present. The fourth source of competitive advantage is the cost advantage, the ability to produce goods or services at a lower cost than competitors, not temporarily, but structurally, due to characteristics of the business model that are difficult to replicate. Cost advantages can arise from several distinct sources. Unique access to low-cost inputs, a mine or quarry or natural resource deposit that competitors cannot access at equivalent cost. More efficient processes, manufacturing or operational approaches that produce the same output at lower cost and that competitors cannot easily copy. Scale advantages, the ability to spread fixed costs over a larger volume of output, producing a lower per-unit cost that smaller competitors cannot match. Walmart built its dominance in U.S. retail substantially on a cost advantage rooted in logistics, distribution infrastructure, and purchasing scale. Its ability to negotiate lower prices from suppliers by virtue of its enormous purchasing volume allowed it to offer lower retail prices than competitors while maintaining acceptable profitability. Competitors who tried to match Walmart's prices without its scale simply could not sustain the margins required to operate profitably. Southwest Airlines maintained a cost advantage in U.S. aviation for decades through a combination of operational choices, operating a single aircraft type, turning aircraft faster at gates, managing fuel costs through hedging, that produced lower cost per available seat mile than larger competitors with more complex operations. This cost advantage allowed Southwest to offer lower fares while remaining profitable in markets where competitors were losing money. The analytical challenge with cost advantages is assessing their durability. A cost advantage based on a proprietary process can be eroded if competitors invest sufficiently in developing a comparable process. A cost advantage based on scale can be threatened if a competitor achieves equivalent scale. A cost advantage based on unique resource access is the most durable because the resource itself cannot be replicated.
Chapter 4. What is not a moat? The most expensive analytical mistake in stock investing. Understanding what constitutes a genuine economic moat is only half the analytical task. Equally important, and perhaps more practically valuable, is understanding what does not constitute a moat, despite frequently being mistaken for one. Dorsey's framework is unusually explicit about this, and I think this explicitness is one of its most important contributions, because the mistakes that destroy investors' returns are very often not the result of ignoring competitive advantage entirely. They are the result of paying a premium for characteristics that feel like competitive advantages, but that competition can erode much faster than the investor anticipated. The first thing that is not a moat is a great product. This is perhaps the most counterintuitive point in the entire framework, and I want to take time with it because it runs against instinct so strongly. A company with a genuinely excellent product, one that outperforms competitors, that customers love, that earns strong reviews, does not necessarily have a moat, because a great product can be copied. The history of business is littered with examples of companies that made genuinely excellent products, earned strong market share on the basis of that quality, and then watched competitors copy or improve upon those products and erode the market position. Palm was the dominant personal digital assistant of its era and made an excellent product. Apple copied and dramatically improved it with the iPhone. Palm's product quality did not protect it from competitive displacement. BlackBerry made the dominant smartphone of the mid-2000s. It was genuinely excellent for its purpose, secure, efficient, favored by professionals worldwide. Its product quality did not prevent iOS and Android from displacing it from its market position with remarkable speed. Great products without structural moats are vulnerable to better products, and better products will always eventually appear. The question is not, is this product excellent? The question is, what prevents a competitor from making an equally excellent or better product and taking the customers? The second thing that is not a moat is high market share.
Large market share can be a consequence of a moat, but it is not itself a moat. A company can have large market share in a market where there are no structural barriers to competition, and that market share can erode quickly when a better funded or better positioned competitor enters. Kodak had enormous market share in film photography. The share reflected decades of brand building, distribution relationships, and manufacturing expertise. But film photography had no structural moat against digital photography, a fundamentally different technology that made Kodak's advantages irrelevant. The market share was not protection. Nokia had dominant market share in mobile phones throughout the 2000s. By volume and by revenue, it was the largest mobile phone company in the world. When the smartphone era arrived, that market share provided almost no protection. The capabilities required to compete in the smartphone era were different from those that had built Nokia's feature phone dominance. The third thing that is not a moat is operational excellence. A company that executes its operations exceptionally well, that manages its supply chain efficiently, that delivers excellent customer service, that runs its manufacturing or service delivery with unusual precision has a genuine competitive advantage in the short term. But operational excellence is fundamentally replicable. Competitors can hire the same consultants, implement the same systems, train their people to the same standards. Operational excellence is a necessary condition for sustained competitive success. It is not a sufficient condition. A company that relies on doing what it currently does better than competitors without any structural characteristic that prevents competitors from matching its execution will eventually see its operational advantage eroded. Chapter 5. Evaluating moat durability. How long can the advantage last? Evaluating that a moat exists is the beginning of the analytical work. Assessing how durable that moat is, how likely it remains intact over the investment horizon, is the harder and more important part. Dorsey's framework distinguishes between wide moats, competitive advantages expected to remain intact for 20 years or more, and narrow moats, competitive advantages expected to provide meaningful competitive protection for 10 years or so. This distinction matters enormously for valuation. A business with a wide moat can be valued assuming that its above-average returns on capital will persist for a much longer period. A business with a narrow moat must be valued more conservatively, with the assumption that competitive erosion will arrive sooner. Paying a wide moat valuation for a narrow moat business is one of the most common and most expensive mistakes in growth stock investing. How do you assess moat durability? Several factors are relevant. First, the nature of the moat source. Network effect moats and switching cost moats tend to be among the most durable because they are self-reinforcing. The larger the network, the stronger the network effect. The deeper the switching costs are embedded in a customer's operations, the more expensive switching becomes over time rather than less. Brand moats can be very durable when the brand is associated with a genuinely emotional or identity-based consumer preference, but can erode if the brand becomes associated with poor quality, or if demographic shifts reduce the relevance of the brand to emerging consumer cohorts. Second, the rate of technological change in the industry. Industries where technology changes slowly tend to favor moat durability. Industries where technological change rapidly, where new technological approaches can render existing competitive advantages obsolete, are hostile to moat durability. A brand or switching cost moat in a stable, mature industry is more durable than an equivalent moat in a rapidly evolving technology sector. Third, the competitive dynamics of the industry. Industries with many well-funded competitors constantly seeking to displace the incumbent are challenging for moat durability than industries with few competitors and limited new entrant activity. The intensity of competitive pressure is a direct determinant of how hard the moat has to work to protect the business.
Let me walk through a case study that illustrates moat durability assessment in practice. Microsoft's competitive position in enterprise productivity software represents one of the most instructive moat durability cases of the past 30 years. In the early 1990s, Microsoft's Windows operating system and Office productivity suite achieved dominance through a combination of network effects, compatibility between users required using the same software, and switching costs. The investment in learning Microsoft products created friction against switching. As Microsoft's dominance became established, competitors recognized the market opportunity and invested heavily in alternatives. Netscape, Sun Microsystems, IBM, and later Google all attempted to displace Microsoft's enterprise software position. None have succeeded in any sustained way during the period of Windows and Office dominance. The reason the moat held was the combination of factors. The switching costs embedded in enterprise deployments of Microsoft Office were genuinely high. Not just the cost of replacing the software, but the cost of retraining entire workforces, the cost of data compatibility issues, the risk of productivity disruption during transition, and the network effect of file format compatibility. Documents created in Microsoft Word could be shared with essentially any business contact in the world, made moving to an incompatible system genuinely costly. The eventual disruption of Microsoft's desktop software moat through the shift to cloud-based productivity tools and mobile computing did not disprove the moat concept. It illustrated moat durability assessment. The moat was genuine and wide within the context of the desktop computing paradigm. When the computing paradigm shifted, the moat had to be rebuilt in the new environment. Microsoft successfully navigated this transition under Satya Nadella's leadership, rebuilding its competitive position in cloud services. But a moat durability assessment in 2005 that failed to account for the possibility of a computing paradigm shift would have been incomplete.
Chapter 6: Return on Invested Capital, the Financial Fingerprint of a Moat. We have discussed the qualitative concept of an economic moat, what it is, where it comes from, and how to assess its durability. Now I want to turn to the financial metrics that reveal whether a moat is actually present, independently of the qualitative narrative. The most important of these metrics is Return on Invested Capital, ROIC. This is a measure of how efficiently a business generates profit from the capital invested in it. It is calculated by dividing the business's operating profit, after tax, by the total capital employed in the business, including both debt and equity. A business without a moat will, over time, earn a return on invested capital approximately equal to its cost of capital, the rate of return that investors require to justify investing in the business. Competition erodes returns until they are just sufficient to retain capital in the industry. This is the fundamental economic equilibrium that competitive markets produce. A business with a genuine moat consistently earns a return on invested capital above its cost of capital. The competitive advantage allows it to generate more profit per dollar of capital deployed than the market equilibrium would produce in the absence of the moat. And this sustained differential between what the business earns on its capital and what it costs to provide that capital is the source of the business's ability to create shareholder value over time. This is why ROIC is the financial fingerprint of a moat. You do not need to conduct a qualitative analysis of every industry dynamic to identify whether a moat is present. You can look at the historical ROIC trajectory. If a business has consistently earned 20 or 25 or 30% returns on invested capital over a decade or more across multiple economic cycles, something structural is protecting those returns. Competition has tried to erode them and has failed. Conversely, a business whose ROIC has been declining consistently over a decade, despite management's assurances about its competitive position, is telling you something important through its numbers. The moat, whatever it once was, is eroding. The returns that once seemed protected are being competed away. The financial trajectory is a more reliable guide to competitive position than management commentary.
Some historical ROIC figures to calibrate the concept. Coca-Cola has generated returns on invested capital consistently above 20% for decades. Moody's Corporation, the credit rating agency, has generated returns on invested capital exceeding 50% in many years, reflecting the extraordinary moat created by its regulatory position and the network effects inherent in the credit rating business. In contrast, a typical airline earns returns on invested capital below its cost of capital in most years, generating returns insufficient to compensate investors for the capital deployed, which is why the airline industry, despite enormous revenue, has historically been a poor investment for most shareholders. Warren Buffett has described the airline industry as a capital trap, a business that requires continuous reinvestment of capital to maintain its competitive position, earns returns that are insufficient to justify that investment, and consistently destroys shareholder value despite serving enormous demand. Understanding ROIC as the financial expression of competitive advantage explains why businesses that appear impressive by revenue or market presence can be genuinely poor investments. Free cash flow generation is closely related to ROIC and equally important as a quality signal. A business with a genuine moat not only earns high returns on invested capital, but generates cash, real money that accumulates after all capital expenditures required to maintain and grow the business. Free cash flow is the financial oxygen of a high-quality business. It funds dividends, share buybacks, debt repayment, and reinvestment at high returns. The relationship between earnings and free cash flow is an important quality check. Some businesses report strong earnings but minimal free cash flow because the earnings require heavy reinvestment to sustain. A business that earns $1 of reported profit but must immediately reinvest 90 cents of it to maintain its competitive position is not as valuable as a business that earns $1 and can retain and deploy it freely. The distinction between reported earnings and genuine free cash flow generation is an important analytical filter for assessing business quality.
Chapter 7. Management Quality: What it actually contributes and what it does not. Most investor discussions of business quality spend significant time on management, the quality of the CEO, the strategic vision of the leadership team, the cultural characteristics that management has instilled. Dorsey's framework takes a notably clear-eyed position on management's contribution to investment returns, a position that is counterintuitive enough to be worth exploring carefully. The position is this: for businesses with wide economic moats, management quality matters relatively little for long-term investment returns. The moat, the structural competitive advantage, is the primary driver of long-term value creation. A competent but unremarkable management team running a wide moat business will produce excellent results because the business's competitive position does the heavy lifting. A brilliant management team running a business without a moat will struggle to generate sustained above-average returns because there is no structural protection for the returns they generate. This is a significant departure from the conventional investment wisdom that great management is the key to great investment performance, and the evidence supports Dorsey's more skeptical view. Research on the persistence of investment performance attributable specifically to management quality, holding industry and competitive position constant, finds that management's marginal contribution to value creation is real, but smaller than most investors assume. Warren Buffett has made the same point in characteristically memorable form. He has said that he looks for businesses so good that an idiot could run them, because sooner or later one will. The implication is that businesses requiring brilliant management to sustain their competitive position are inherently riskier investments than businesses whose competitive advantage is structural and largely independent of who is sitting in the CEO chair. There are specific circumstances, however, where management quality matters greatly, and being clear about when those circumstances apply is the nuanced version of this principle. Management quality matters most at businesses at pivotal transitions.
a wide moat business navigating a technological disruption, as Microsoft was navigating the transition from desktop to cloud computing, genuinely depends on management judgment to determine whether the moat can be rebuilt in the new environment. A business deploying significant capital through acquisitions depends on management's capital allocation judgment to ensure that the acquisitions create rather than destroy value. Capital allocation is the specific management competency that matters most for long-term investment returns. The decisions a management team makes about what to do with the cash the business generates, whether to reinvest in the business, pay dividends, repurchase shares, or make acquisitions, have a large and direct impact on per-share value creation over time. The best capital allocators in business history, Warren Buffett at Berkshire Hathaway, John Malone at various cable and media businesses, Henry Singleton at Teledyne, generated extraordinary shareholder returns not primarily through operational brilliance, but through exceptionally disciplined and intelligent deployment of capital. They understood the difference between investments that earned high returns and those that merely employed large amounts of capital. They were ruthless about directing capital toward the highest return opportunities available to them. The worst capital allocators, managers who make expensive acquisitions at premium prices driven by empire-building impulses rather than return analysis, who buy back shares when the stock is expensive and issue shares when it is cheap, who invest in low-return expansion because growth feels strategic, can destroy substantial amounts of value, even in businesses with genuine moats. The analytical task is to identify management teams that are honest about the competitive position of their business, that demonstrate genuine understanding of return on invested capital and free cash flow, that make capital allocation decisions based on financial analysis rather than strategic narrative, and that have track records of doing what they said they would do. The simplest management quality test is also the most revealing. Read the company's annual reports from 5 or 10 years ago. Look at what management said they would accomplish, then compare those statements to what actually happened. The gap between stated intentions and actual outcomes over a long enough period is the most reliable indicator of management quality available.
Chapter 8. Valuation. The price you pay determines the return you get. We have now established the framework for identifying high-quality businesses, businesses with genuine economic moats, durable competitive advantages, high returns on invested capital, and competent capital allocation. The final analytical question is the one that determines whether the identification of quality translates into investment returns. How much should you pay? This is where many otherwise excellent analysts make their most expensive mistakes. The identification of a high-quality business is one half of the investment equation. The price paid for that business is the other half. A wonderful business purchased at an excessive price is a poor investment. A mediocre business purchased at a sufficiently low price can be a reasonable one. The tool Dorsey emphasizes most strongly for relating price to value is the discounted cash flow framework. The concept behind it is straightforward, even if its execution requires judgment. A business is worth the present value of all the cash it will generate over its lifetime, discounted back to today at a rate that reflects the risk of those cash flows. Pay less than this present value, and you own something worth more than you paid. Pay more, and you own something worth less than you paid. In practice, the discounted cash flow approach requires estimates of future cash flows that are genuinely uncertain. The analyst must make assumptions about how fast the business will grow, how long its moat will persist, what its terminal value will be when the moat eventually erodes. Small changes in these assumptions produce large changes in the estimated value. This sensitivity to assumptions is not a weakness of the discounted cash flow approach. It is an honest reflection of the genuine uncertainty involved in predicting business performance over multi-decade horizons. Acknowledging this uncertainty and building a margin of safety into the price paid to account for it is the appropriate response.
The price-to-earnings ratio is the simpler and more widely used valuation metric, and Dorsey provides useful context for interpreting it. A P/E ratio reflects the market's implicit assumption about the company's growth rate and the durability of its competitive position. High P/E ratios are only justified when the growth rate is genuinely high and the competitive position is genuinely durable. When one or both of these conditions is not met, a high P/E ratio implies future disappointment. The most important insight about valuation in the context of moat analysis is this: a wide moat business can justify a higher valuation than a narrow moat or no moat business, because the persistence of above-average returns supports a longer period of value creation. But even a wide moat business can be overpriced. The moat does not guarantee that any price is justified. It simply means that the range of justifiable prices is wider than for businesses without moats. Dorsey provides a useful mental framework for thinking about what growth is worth. Growth creates value only when the business can reinvest at returns above the cost of capital. A business that can reinvest at 30% returns on invested capital creates enormous value through growth. Every dollar reinvested generates 30 cents of annual return. A business that can only reinvest at 8% returns, equal to its cost of capital, creates no additional value through growth. Investors who pay premiums for the growth of businesses that cannot reinvest at above cost of capital rates are paying for something that does not create value. This insight explains why high-revenue growth companies in commodity industries, companies that are growing rapidly but that must reinvest heavily in low-return capital just to maintain their competitive position, frequently disappoint investors who paid growth premiums. The growth is real. The value creation is not, because the reinvestment required to generate the growth consumes all the cash the growth produces.
Chapter 9: The 5 mistakes that destroy investors' returns and how to avoid every one. Theory is only as useful as its application, and the most practical dimension of this entire analytical framework is its ability to protect investors from the specific mistakes that reliably destroy long-term returns. Dorsey identifies the most costly and most common mistakes in stock investing with unusual specificity. Let us go through each one carefully. Mistake 1: paying too much for a stock with great near-term prospects. The most expensive stocks in the market at any given time are usually the ones whose near-term growth prospects are most visible and most exciting. A company growing revenues at 50% per year in a market that is clearly expanding rapidly, attracting enormous investor enthusiasm. Such a company typically trades at valuations that imply the continuation of exceptional growth for many years into the future. The problem is that exceptional growth rates are rarely sustained. The market opportunity that made 50% revenue growth possible at one scale becomes harder to sustain as the company grows larger. Competition intensifies as the market opportunity becomes clearer to other potential entrants. The very success that drove the exceptional growth makes future comparable growth mathematically harder. Investors who pay 60 or 80 or 100 times earnings for a business whose exceptional growth slows to 20 or 30%, still impressive by any normal standard, can lose money even as the underlying business continues to perform well by conventional measures. The stock price was pricing in continuation of exceptional performance. Merely good performance disappoints. Mistake 2: falling in love with a company. This mistake is psychological rather than analytical, and it is among the most pervasive and most costly in investment practice. An investor who has owned a business for several years, who has studied it thoroughly, who has watched it perform well and validated their original thesis, naturally develops a positive emotional attachment to it. That attachment can prevent the honest reassessment that investment discipline requires.
When the business's competitive position begins to erode, when the moat starts to narrow, the investor who loves the company sees the early signals and dismisses them. The deteriorating ROIC is temporary. The competitive pressure is manageable. The management team that performed so well historically will navigate this too. The most reliable protection against this mistake is a pre-specified set of conditions under which you will reassess a holding and potentially sell it. If the return on invested capital declines for 3 consecutive years with no structural explanation, if a competitor successfully enters the market and demonstrates the moat is narrower than assessed, if management makes capital allocation decisions that are clearly value-destructive, these tripwires, established in advance before emotional attachment is formed, provide the objectivity that love prevents. Mistake 4. Panicking when prices fall. We covered the behavioral economics of this in the psychology video. Loss aversion makes falling prices feel more alarming than rising prices feel reassuring. Mr. Market's pessimism is contagious, and the financial media's tendency to present price declines as crises creates enormous psychological pressure to sell when prices fall. The appropriate question when a stock price falls is not, "Should I sell to stop the pain?" The appropriate question is, has the business's competitive position changed, or has only the market's current assessment of it changed? If the moat is intact, if the return on invested capital is maintained, if the long-term earnings power is undiminished, a price decline is not a reason to sell. It may be a reason to buy more. The investors who generated the extraordinary long-term returns from stock ownership, Buffett's purchases of Coca-Cola, American Express, and Washington Post, among dozens of others, almost all involved holding through periods of significant price decline without selling. The conviction required to hold the falling stock is only available to investors who have done genuine analytical work, who know what the business is worth independently of what it is currently priced at. Mistake 4. Ignoring valuation entirely. The mirror image of mistake 1 is the mistake of assuming that a high-quality business can be purchased at any price and held indefinitely with confidence. The moat matters, the quality matters, but so does the price. In the late 1990s, the consumer staples companies that Buffett had built Berkshire's portfolio around, Coca-Cola, Gillette, and American Express, among others, were trading at valuations that had expanded dramatically from the levels at which Buffett had originally purchased them. The businesses had not deteriorated, their moats were intact, but the market was paying so generously for their quality that the forward returns available from the current price were modest. Buffett has acknowledged that Berkshire's returns in the 2000s were dampened by the high prices paid for some holdings in the late 1990s. The businesses were excellent. The prices were too high for excellent future returns to be achievable. Quality is not a substitute for valuation. Mistake 5. Relying on earnings per share as the primary quality metric. Earnings per share can be influenced by accounting choices, by share buybacks, by leverage, and by management's reporting decisions in ways that make it an unreliable guide to the true economic performance of a business. Two businesses can report identical earnings per share while having dramatically different underlying economics, different levels of cash generation, different capital requirements, different sustainability of the reported earnings. The superior quality metric is free cash flow per share, the actual cash generated by the business per share after all necessary capital expenditures. Cash is harder to manipulate than reported earnings. A business that consistently generates strong free cash flow per share is almost certainly performing well economically. A business that reports strong earnings per share but generates weak free cash flow should be examined carefully for the accounting or capital structure reasons behind the divergence.
Chapter 10. Putting the framework together, a practical investment process. We have now covered all the major analytical components of this framework. the economic moat concept, the 4 sources of competitive advantage, the distinction between genuine moats and moat imposters, the financial metrics that reveal competitive advantage in the numbers, the role of management quality and where it matters most, valuation as the bridge between business quality and investment return, and the 5 mistakes that most reliably destroy returns. Let me now describe how these components fit together into a practical investment process, not an abstract description, but a concrete sequence of questions and analytical steps. Step 1. Does this business have an economic moat? Before evaluating any other characteristic, this is the threshold question. Apply the 4-source framework. Is there a brand with genuine pricing power? Are there meaningful switching costs embedded in the customer relationship? Is there a genuine network effect making the product more valuable as more people use it? Is there a structural cost advantage that competitors cannot easily replicate? If none of these is convincingly present, the business does not have a moat, and the analytical work should conclude here, or should be specifically focused on whether the business is cheap enough to justify owning without a moat. Step 2. How wide is the moat, and how durable is it? If a moat is present, assess its width and durability. What is the nature of the competitive advantage? How resistant is it to technological change? How intense is the competitive pressure in the industry? Is the moat widening over time, becoming more entrenched, or narrowing? Step 3. What do the financial metrics say? Look at the historical ROIC trajectory over at least 5 years, preferably 10. Is it consistently above the cost of capital? Is it stable or declining? Compare ROIC to industry peers. A business with structurally higher ROIC than its industry peers is demonstrating financial evidence of a moat. Look at free cash flow generation. Is it strong relative to reported earnings? Is it growing? Step 4. Is management a creator or destroyer of value? Examine capital allocation decisions over the past 5 to 10 years. What have they done with the free cash flow generated? What do the acquisitions made look like? Have they created or destroyed value? Has management's guidance and promises matched actual performance? Is the management team honest and direct in discussing competitive challenges, or do they spin difficulty as opportunity? Step 5. What is the business worth, and what is Mr. Market currently charging? Construct a conservative estimate of intrinsic value using discounted cash flow analysis, comparable company multiples, or both. Build a margin of safety into the price you are willing to pay. A wide moat business might warrant paying up to a modest premium to your conservative estimate of intrinsic value because the durability of the moat supports value creation over a longer period than your conservative assumptions imply. A narrow moat or no moat business should be purchased at a meaningful discount to conservative estimated value. This 5-step process is not quick. A thorough application of it to a single investment candidate, reading annual reports, analyzing financial statements, researching industry dynamics, evaluating management track records, may take 20 to 40 hours of work. This is one of the honest realities of the stock-picking endeavor. Doing it well requires real work, not the casual reading of analyst summaries or financial news. Deep primary source analysis of the kind that produces genuine understanding of businesses that makes confident, patient investment possible.
Chapter 11. The Compounding Engine. Why Moat Investing Produces Extraordinary Long-Term Results. I want to spend time on the mathematical and conceptual reason why the moat-focused approach to stock investing produces results that, over extended periods, dramatically outperform the alternatives. Because understanding this mechanism, really understanding it, not just knowing it intellectually, is what sustains the discipline required to execute the approach through the periods when it requires patience. The mechanism is the compounding of high returns on invested capital over time. Consider 2 businesses. Business A earns a 10% return on invested capital and reinvests all of its earnings back into the business. Business B earns a 25% return on invested capital and reinvests all of its earnings back into the business. Both start with $100 of capital. After 1 year, business A has $110. Business B has $125. The difference is $15, meaningful but not dramatic. After 10 years, business A has $259. Business B has $931. The same starting capital, the same reinvestment rate, the same time. The only difference is the rate of return on invested capital. The compounding of a higher return rate over time produces a difference that is not proportional to the rate difference. It is exponentially larger. After 30 years, business A has $1,745. Business B has $8,032 per original $100 of starting capital. This is the mathematical engine of wide moat investing. Owning businesses that earn high returns on invested capital and that can reinvest at those high returns for extended periods produces compounding that over a long enough time horizon swamps the importance of nearly every other variable, including the price paid at the outset. This is why Warren Buffett has described his approach as buying wonderful businesses at fair prices rather than fair businesses at wonderful prices, an evolution from Graham's original focus on cheap assets. The compounding of returns from a wonderful business held for 30 years produces outcomes that dwarf the returns from a mediocre business purchased at a bargain price and held for the same period. Microsoft, from its IPO in 1986 through 2020, is perhaps the clearest documented example of this compounding mechanism in modern stock market history. Microsoft's competitive position in operating systems and productivity software, its network effect and switching cost moats, allowed it to earn extraordinarily high returns on invested capital for decades. The compounding of those returns produced one of the largest accumulations of shareholder value in corporate history. Amazon, from its early public years through 2020, demonstrates the same mechanism applied in a different structural form. Amazon's early years produced minimal reported earnings, but the company was building competitive advantages in logistics infrastructure, in cloud computing, in marketplace network effects that would eventually generate high returns on invested capital at massive scale. Investors who understood what was being built and who had the patience to hold through years of minimal reported earnings were rewarded by the eventual expression of those competitive advantages in financial returns. The patience required is real. High-quality businesses with genuine moats frequently trade at valuations that imply modest near-term returns. The full expression of the moat's value creation occurs over years and decades. Investors who lack the patience to wait, who sell after 1 or 2 years of mediocre price performance, systematically miss the compounding that makes the approach work.
Chapter 12. Applying this framework today, what to look for and where to look. The analytical framework we have explored throughout this video is timeless in its conceptual foundations, but requires ongoing application to current market realities. Let me spend time on what applying this framework looks like in the current investment environment. The businesses with the most clearly identifiable wide moats in the current market tend to cluster in specific industries and competitive structures. Technology platforms with genuine network effects represent some of the clearest wide moats observable in modern markets. The value exchange networks, payment processing companies, benefit from bilateral network effects between consumers and merchants that have proven highly durable. The enterprise software companies with deeply embedded products and high switching costs maintain positions that have resisted significant competitive pressure. Consumer goods companies with genuinely powerful brands, companies whose products command premium prices because of authentic consumer preference rather than mere awareness, continue to represent one of the most accessible and most documented moat categories. The challenge in this category in the current environment is distinguishing brands that retain genuine pricing power from those that are losing relevance to changing consumer preferences. Financial services businesses with structural competitive advantages, insurance companies with superior underwriting expertise, asset management businesses with strong distribution relationships and track records, credit rating agencies with regulatory-supported positions represent moat opportunities that are often overlooked because the business models are less glamorous than technology. Healthcare businesses with moats rooted in proprietary data, clinical evidence, or regulatory approvals that competitors cannot easily replicate continue to offer genuine moat investment opportunities. Though the regulatory and reimbursement environment creates complexity that requires careful analysis. The industries where moats are most difficult to sustain and where investors should apply the highest degree of skepticism to competitive advantage claims include commodity manufacturing, most retail, airlines, most media content, and any industry where rapid technological change makes current competitive positions structurally vulnerable. A practical starting point for applying this framework is to identify businesses in your own life, products and services you use, where you notice that you continue using them despite the availability of cheaper or apparently comparable alternatives. The inertia you feel about switching is itself a data point about the switching cost or brand moat that the supplier has built. Your own consumer behavior is a laboratory for moat identification that is always available to you. The financial screening tools available to individual investors today make the analytical component of moat identification more accessible than any previous point. Databases that provide historical ROIC, free cash flow generation, and gross margin trajectories across thousands of companies allow investors to identify businesses with the financial fingerprints of competitive advantage before conducting deeper qualitative analysis. The quantitative screen narrows the analytical universe. The qualitative work then determines whether the financial fingerprint reflects a genuine structural moat. Closing. What to do with this framework starting today? We have covered a remarkable amount of analytical terrain. Let me bring it home with something immediately actionable. The framework we have explored, moat identification, moat durability assessment, ROIC analysis, management quality evaluation, valuation discipline, and mistake avoidance, is a complete investment philosophy, not a set of tips. A coherent, internally consistent way of thinking about what makes a business genuinely valuable and what makes a stock genuinely worth owning. 3 things you can do this week to begin applying it. First, pick one company you currently own or are considering owning. Ask the threshold question: what is the source of this business's competitive advantage? Is it a genuine moat, a brand with pricing power, a switching cost, a network effect, a structural cost advantage, or is it a great product, large market share, or operational excellence that competition can erode? Second, look up the historical return on invested capital for that company over the past 10 years. If you are in the United States, this data is available on Morningstar, on the company's own SEC filings, or on financial data platforms. Is the ROIC consistently above the cost of capital? Is it stable, growing, or declining? What does the financial fingerprint tell you? Third, read the company's most recent annual report, specifically the letter to shareholders if one exists, and the management discussion and analysis section. Look for honesty about competitive challenges. Look for specific, trackable statements about what management intends to accomplish. File those statements somewhere you'll see them when you read next year's annual report. These 3 actions will not make you an expert analyst in a week. They will make you a more rigorous, more honest, more disciplined evaluator of the businesses you choose to own. And that improvement in analytical quality, applied consistently over years, is the difference between an investor who generates mediocre results and one who generates results that genuinely build wealth. The stock market is not primarily a casino. It is not primarily a voting machine registering current enthusiasm. It is, over any extended period, a weighing machine, reflecting the actual fundamental value creation of the underlying businesses. The investor who understands how businesses create value, who can identify the structural characteristics that protect that value creation over time, and who has the discipline to pay only reasonable prices for what they buy, that investor owns the weighing machine. Everyone else is at its mercy.
Thank you for spending this time with me. If this framework gave you a clearer picture of what serious stock analysis actually requires, share it with someone whose investment life it might improve. These ideas are worth spreading. I will see you in the next one.